As you've heard me allude to a few times, risk and rates of return are strongly correlated. As a matter of fact, rates of return are really a measurement of risk, and we're going to explore that here in Chapter 8. So, risk is the chance that something unexpected will occur, and that includes, and this is hard sometimes to understand, upside as well as downside. So you have a expected return, and then any variation off that expected return, whether it's upside variation or downside variation, is technically risk. And risk can be measured with a probability distribution, and it's essentially a listing of all possible outcomes with probability assigned to each. And we can then analyze that to determine whether the risk is skewed to the upside or skewed to the downside or normally distributed. And then additionally, how to value or evaluate that risk. So for instance, in this particular case, there's a probability that it's either going to rain or not rain. So it's a binary situation. There's only two possible outcomes. And so you've got a probability of 40% rain, probability of no rain 60%, and a total probability equals 100. When we look at that in a business setting, you still have to have a probability of the outcomes coming to 100%, but you can have more granularity or more choices in what those outcomes are. So in this case, we're looking at Martin Products and U.S. Electric, and the economy could either be in boom, it could be normal, or it could be in recession. And then we have the analysis here. So you have a rate of return on the stock if the economic state occurs on Martin Products. And so if Martin Products, if it's a boom, it's 110% expected rate of return. If it's normal, it's a 22% rate of return. And if it's a recession, it's minus 60% rate of return. And the rate of return on the stock on U.S. Electric, if it's a boom, 20%, normal 16%, recession 10%. And you can see in the second column the probability of each one of those states occurring. So the probability of a boom is 20%, the probability that it's going to be normal is 50%, the probability of a recession is 30%, which comes to 100%. So we're going to see which is more risky, whether it's Martin Products or U.S. Electric. And you could probably tell already, given the variance of distribution, which is the riskier stock. But we're going to go through a little bit of a calculation here. So the expected rate of return is the average rate of return expected to be realized from an investment during its life. And it's the mean value of the probability distribution of possible returns and the weighted average of the outcome where the weights are probabilities. So in this particular case, you would determine what the expected rate of return is for both Martin Products and U.S. Electric by multiplying the probability by the return for that particular scenario, and then adding that together. And that's what this shows here. The probability of return 1 times return 1, the probability plus the probability of return 2 times return 2, plus the probability, et cetera, out to the probability of return n times return n. Risk is evaluated based upon standard deviation. And standard deviation is a very common calculation associated with statistics, business statistics. And it essentially measures the amount of variation at 1 standard deviation, 2 standard deviations, 3 standard deviations, essentially how many times or what this, it'll indicate what the shape of the probability curve looks like and how much distance there is between each of those probabilities. So you'll take the return at R1 minus the expected return squared times the probability of R1 plus return 2 minus the expected return, which is R hat, squared times the probability of return 2. You'll sum all that together, you'll take the square root, and that will give you the standard deviation. In the case of Martin Products, you had these three scenarios, 110% for a boom, 22% for normal, and minus 60% for a down economy. The expected return is 15%, which is essentially when you go through and you multiply this 110% when you go through this exercise here, you get an expected rate of return of 15%. Just like on this side, you get an expected rate of return of 15%. When we calculate the standard deviation, if you take R minus R hat, which is the expected return, you get 95. You square it, you get 9,025. You multiply it by the probability of 0.2, so 9,025 times 0.2 is 1,805. And then you do that for the 22% probability for normal and the minus 60% expected rate of return for the bust or for the down market. And again, because you have a square and then a square, and then because you have a square, it makes this negative number a positive. So your variance, which is sigma squared, is always going to be a positive number, and your standard deviation is always going to be a positive number because your standard deviation is the square root of the variance, and this is how you calculate the variance. Walking through it, you take the sum, which is 3,517, you take the square root of that, and you get a standard deviation of 59.3%. When we measure risk, we measure a coefficient of variation, and that's calculated as the standard deviation divided by the expected return. And when you have investments where the expected return and the risk level are different, risk is measured by standard deviation, expected return is measured by R hat. This gives you, this coefficient of variation gives you essentially a level set associated with what that will look like. So you can compare essentially an apples to apples. A risk-averse investor requires higher rates of return to invest in higher risk securities. So all things being equal, if you're looking for a specific rate of return, and you're taking additional risk, you will want to have a higher rate of return. And there's a risk premium, and that risk premium is the portion of the expected return that's attributed to an investment's riskiness. And the difference between the expected rate of return on a given asset and that on a less risky asset is considered the risk premium as well. So when we look at this graph, you can see that there's a risk-free rate, and you'll see that's generally going to be in this class shown as R sub RF, or R star, which is the real rate of return plus the inflation premium for the period. That's going to give you the risk-free rate. And the risk-free rate essentially takes a look at the risk-free return plus the inflation premium. And that risk-free rate you'll see is flat. As you look at securities that have higher risk, the required return goes up over time. So the important thing conceptually to understand here is as risk goes up, the required rate of return goes up. Similarly, if you're looking at an investment and it has a high rate of return, you are probably also looking at an investment that has high risk. So the expected return on a portfolio, and a portfolio is a grouping of financial assets. So it could be a portfolio of bonds, stocks, portfolio of investment, real estate, could be anything where you've got multiple types of investments put together. That becomes a portfolio. And so the expected return on a portfolio is the weighting of the asset one times the expected return on asset one, plus a weighting of asset two times the expected return of asset two, and on until you have the weighting of asset n times the expected return of asset n. So the weighted average expected return on a portfolio is the weighted average of the expected return of the stocks held in the portfolio. The realized rate of return, R umlaut, or R double dot, is the rate of return that's actually earned. And the actual rate of return almost always is going to be different from the expected return, and that difference is risk. That's essentially the risk you're taking, is that you have an expectation. That expectation isn't met. It could be higher, it could be lower, but the measurement of the probability of that return is generally considered to be risk, and so therefore you've got a realized rate of return, R double dot, and that's going to be the realized rate of return, and that's usually different from your expected return. When we're looking at portfolio risk, there's an element around correlation. So correlation is a degree of relationship between two variables. Positively correlated stocks have a rate of return that move in the same direction. So, for instance, if it's positively correlated, then this would indicate that the correlation is greater than zero. That means if one stock goes up, the other stock likely will go up as well. Or if one stock goes down, that the next stock will likely go down as well. Negatively correlated stocks have rates of return that consistently move in opposite directions. So if one stock goes up, the other stock will go down. And so the classic example is you may have a stock that's like guns and butter, and you have a chance to choose between guns and butter. But if you choose guns, the price of butter will go down, and if you choose butter, the price of guns will go down, and that's a supply and demand issue. But it also becomes a correlation issue. They're negatively correlated. So in order to reduce risk, you're going to combine stocks that are not perfectly positively correlated, because you create diversification. Essentially, if one stock goes up and the other stock goes down, or if one stock goes up and another stock goes up by a smaller amount, as long as they're not perfectly correlated, you're going to get some diversification. Diversification is a key to building a portfolio that moves closer and closer and closer to the expected return. The riskiness of a portfolio is reduced as the number of stocks in a portfolio increases. So if you only had one stock in your portfolio, and all your eggs were in that one basket, you can do extremely well or extremely poorly. But you're likely to see, potential significant variation in your performance. If you held the entire stock market, a portfolio which included the entire stock market, your portfolio would perform exactly the same way the stock market does, and so it's less risky from the standpoint of expected return versus realized return. The smaller the positive correlation of stocks in a portfolio, the lower the portfolio's risk. The greater the negative correlation, so stocks that go up and stocks that go down at the same time, the greater the diversification effect by adding it to your portfolio. So portfolio risk, and this is essentially built off of a study where portfolio risk at one stock, you may have a standard deviation, which is 30% on a single stock, 30% plus. Once you get 20 stocks in your portfolio, your risk, your diversification creates a portfolio which has a standard deviation that's around 17 or 18. And it continues to revert down to the mean. There's a couple concepts here that are important. One is diversifiable risk, and diversifiable risk is the risk that's measured here in the green, is the risk that you can make go away by putting more and more stocks in your portfolio. So essentially, if you had the entire New York Stock Exchange in your portfolio, if you had the entire New York Stock Exchange in your portfolio would perform exactly the same way as the New York Stock Exchange. You'll have diversified out any company-specific risk. If you had one stock, you're going to see most of your risk is company-specific risk. There's a portion of the risk, which is systemic risk or systematic risk, which can't be diversified. Essentially, the stock market's going to do what the stock market does based upon outside market conditions, money, economic fluctuations, etc. And so that can't be diversified away. The important thing to understand, and we're going to talk about this a little bit more, is that you're never going to be compensated for the risk you're taking here. You might do well. You might end up really winning or really losing. But when you're calculating an expected rate of return, you're not going to be compensated for taking diversifiable risk. You're only compensated for taking systemic risk or systematic risk. So firm-specific risk, that's the part of a security's risk associated with random outcomes generated by events or behaviors specific to the firm or specific to the company. Firm-specific risk could be eliminated through proper diversification. You get enough companies in there, and one company having a problem is not going to have a significant impact on your portfolio. That's also called diversifiable risk or unsystematic risk or unsystemic risk. And then you have market risk. Market risk is a part of a securities risk that can't be eliminated through diversification because it's associated with macroeconomic or market factors that systematically affect all companies or systematically affect the entire market. and it's also called non-diversifiable risk or systemic or systematic risk. So the only relevant risk is market risk. That's the only risk that really is relevant when you're looking at how you're compensated for taking risk in finance, because it's the risk associated with a security that you can't diversify away. If you're in that market, you're stuck with the systemic risk of that market. And that risk represents a security's contribution to the total risk of the portfolio. You have a relevant risk you're not compensated for, which is firm-specific risk. That's the risk associated with a security that can be diversified away by adding enough other securities into the portfolio to reduce the impact of that one company having a significant outsized impact on your portfolio's return relative to the market. When we boil this down, there's a concept called beta, and beta is an analysis of a return on stock that measures how volatile or how much and in what direction a stock moves relative to the overall market over a period of time. So beta coefficient is the measure of the extent to which returns on a given stock move with the stock market, which represents the average stock going up or down. The entire market is extremely well diversified, and because it includes all investments, and will have a beta of 1. So if you have a stock that has a beta of 2, it will move. If the market goes up by 10%, that stock will generally go up by 20%. If the market goes down by 10%, that stock will likely go down by about 20%. If you have a stock with a beta of a -1, if the stock market goes up by 10%, that stock might go down by 10%, and vice versa. If the market goes down by 10%, that stock might go up by 10% if it has a beta of -1. So you could have stocks with positive betas and negative betas, and essentially you could think about that as just a multiplier on the impact of a change in market return. So here it is a little bit more spelled out. For a beta of 0.5, a stock is only half as volatile or risky as the average stock. For a beta of 1, a stock has the same systematic risk as the average stock. And a beta of 2, a stock is twice as risky as the average stock. The beta of any set of securities is a weighted average of the individual security betas. So if you think about it, if you have the entire market, and that entire market has by definition a beta of 1, and each one of the stocks in your portfolio is weighted equal to the market, then your portfolio will have a beta of 1. The risk premium for a stock, and we're starting to get into the capital asset pricing model, which is going to be another fundamental component of finance. The risk premium for stock J in this case, is equal to the risk premium of the market times the beta for stock J. And the risk premium for the market is the risk of the market minus the risk-free rate times the beta for stock J. So you can see the definitions here. The risk premium for the market is the market average stock risk premium. The R sub M is the average stock return or the market return, and R sub RF is the risk-free rate of return. Here's an example of the required rate of return for stock RJ. Required return for stock RJ is equal to the risk-free rate plus risk premium for stock J. The risk-free rate stays constant. And if you remember going back a few slides, that was that orange section at the bottom that is kind of sitting there as a risk-free component. And then the part that you are actually being compensated for is a risk premium associated with the market times the specific beta or volatility associated with stock J. And the risk premium for the market is the required rate of return for the market minus the risk-free rate, so minus this, times the beta for stock J. And this, as I had mentioned, is a capital asset pricing model. It's a model used to determine the required rate of return on an asset, which is based on the proposition that any asset's required rate of return should equal the risk-free return plus a risk premium that reflects the asset's non-diversifiable risk, the asset's risk as it pertains to changes in the overall market, not that company specifically. And that's shown here. The required return on stock J is equal to the risk-free rate plus the risk premium multiplied by the beta for stock J. The security market line is a graph of the CAPM, essentially a graph of the capital asset pricing model that shows at various betas what the required rate of return is. And it shows a risk, the relationship between risk and required rate of return for individual securities. Here's a security market line. You can see that here you've got a relatively risky stock with a risk premium of 12. Market average is a risk premium of 6. A safe stock has a risk premium of 3, and a risk-free rate is equal to 5. So at 5, you've got this essentially the minimum amount of risk you're going to take. This is the beta. So 1, 1.5, 2, and 0.5. So at 1, your required rate of return is 5, the risk-free rate, plus the average market risk premium 6 times the beta. So that equals 6 plus 5 is 11. So that's the amount that is essentially required here. When you've got a low-risk stock, you take the market risk premium, which is 6. You multiply it by the beta, which is 0.5. So you get a 3. You add that to the risk-free rate of 5, and you have an 8 as your required rate of return for a low-risk stock. Do the same thing here for a high-risk stock. You've got 6 is a risk premium, so you multiply that by 2. You get 12. So that's because you have a 2 beta. So 6 times 2 is 12, plus 5 is 17. And so that's your rate of return for a high, essentially a high risk stock. The risk-free rate is the price of money to a riskless borrower. It's generally going to be equivalent to the equivalent time horizon for U.S. Treasury. The nominal rate consists of the real rate of return plus the inflation premium, and an increase in expected inflation. So if you think inflation is going to happen and it's going to go up over time, that's going to increase the risk-free rate. And the security market line here would experience a parallel upward shift. So if this went from 5 to 6, this intercept would go from 5 to 6, and everything would just be parallel and go up by 1. The slope of the security market line represents the extent to which investors are risk averse. And an increase in risk aversion increases the risk premium, which increases the slope of the security market line. So the more risk people are willing to take, the security market line goes down. Risk aversion, which is risk that people don't want to take, so people don't want to take risk. If there's an increase in risk aversion, the security market line slope goes up. So a 2 here, if we go back to this line, if there's an increase in risk aversion and this slope goes up, what you may see is this 6 goes up to an 8, and then this turns into 16 because the slope of this line increased. If there's a decrease in risk aversion or people are willing to take more risk, then the slope of this line becomes lower. This relationship of beta to the market risk premium is going to stay steady, but the slope of this line is going to decrease, and the intercept at the 1.0 beta point is going to be lower. Beta of a stock is affected by a number of things. It's affected by the composition of the firm's assets, the firm's use of debt financing, because that provides additional leverage to the end risk associated to the equity. The competitive nature of the firm's industry, expirations of patents and copyrights, which might change their intellectual property or create challenges for the firm, and any change in the required rate of return from a change in beta or expected inflation will affect the stock price. So if the required rate of return goes up, the stock price goes down. If the required rate of return goes down, the stock price goes up. Just like a bond, It's common within every aspect of finance. If the required rate of return goes up, the price of an asset falls. And that's because if you're going to put money out and you're expecting a certain amount of money back, if that certain amount of money you're expecting back is going up in amount, then the amount you have to pay out has to go down in order for you to get your required rate of return. For stock market equilibrium at R hat, actual market price equals its intrinsic value estimated by the average investor, which leads to price stability. Otherwise, buying or selling in the market makes the appropriate adjustment. So if a stock is undervalued in the market, stock market equilibrium says people will identify that stock is essentially undervalued and will create demand by buying that until the market price adjusts. And conversely, if a stock is overpriced, it'll be sold by investors until it reaches an equilibrium price for the average investor. And stock market equilibrium would say the condition under which the expected return on a security, R hat, is equal to its required rate of return. Now, again, generally what you see in the real market is, stocks move every day, and that's a combination of some market inefficiency, the market essentially not being in equilibrium, coupled by small changes in the supply and demand associated with that particular stock. But when you see significant changes in a stock price, that's generally because something has changed fundamentally with the stock where the risk profile has changed. And if you see the entire market going up and down, that's generally going to be economic factors which are going to be impacting the expected or required market rate of return. And we just talked about this a minute ago, but stock prices aren't constant due to changes in risk-free rate, market risk premium, stocks beta, stocks expected growth rate, and changes in expected dividends, in addition to minor issues around supply and demand of shares available. Physical assets versus securities. The riskiness of real assets, so the riskiness of the underlying assets in a business, is only relevant in terms of its effect on the stock risk. We generally don't measure the riskiness of a company by deconstructing the riskiness of each of the components of that company's balance sheet as a physical asset and figuring out what the volatility is. We look at it as essentially as a portfolio of assets, and it's only relevant in terms of that portfolio is only relevant in terms of how does it impact the company's stock price, not necessarily how each small component of physical assets are impacted at that level. So a couple elements of caution with CAPM. CAPM is based on expected conditions. So again, conditions can change. Only historical data is available to measure beta. And so you're essentially extrapolating from historical volatility what future volatility is going to be, and sometimes that does not hold. And so again, as conditions change, future volatility might differ from past volatility, and everything is an estimate. And so therefore your estimates of expected future cash flow, your estimates of stock volatility, your estimates of inflation, basically any one of these elements here that you're estimating as part of the calculation of CAPM, the expected growth rate, expected dividends, market risk premium, risk-free rate, all those are subject to estimate, and those estimates are always subject to error. For systemic risks, these are the type of risks that you're actually going to be compensated for at the market level. Your interest rate risk, inflation, maturity risk premium, liquidity risk premium at that specific market, the exchange rate, if it's an international, and political risk. Non-systematic risks or unsystemic risks include business-specific risks, financial-specific risks associated with the business operational risks, and default risk. And then you've got combined risks, which are essentially the total risk at the company level, which impact how do these unsystemic risks, when combined with the systemic risks in the general market, impact the company's performance. And that's going to be your combined risk at the corporate level. Again, to summarize what we've just covered conceptually, think of it this way. The higher the risk, the higher the required rate of return. There's a lot of different components of risk, but fundamentally, if you see something that has a high return, it probably has a higher risk associated with it. If you see something with a high risk and it looks like it's high risk to you, you're going to require a high rate of return in order to accept that risk. There's no reason to take risk without getting compensated for it. And that's the underlying principle behind this chapter.